Hey guys, Tim Melvin coming to you from down here in Central Florida, which has actually been a pretty nice day. Been a little weather since the last time we talked in the last video. We rode out Hurricane Irma here at home. We had all your basic survival skills. We had a generator, we had plenty of gasoline, we had wine, we had water, we had bourbon, we had frozen coffee drinks. So, we had everything. We had lots of books, of course. We had everything we needed to ride out the storm. Now, we really thought that it looked all day long like the storm was going to veer to the west. And while that was good news for us, it was horrible news for some of our friends in great places like Fort Myers, down in Naples, where one of my oldest friends lived. Had the storm stayed on that track, the storm surge would have been incredibly destructive. Now, that's not saying that I'm overly thrilled that the storm pretty much came right over the house. You could see the storm track change on the radar. And I was like, oh boy, here it comes. And it did get here, and we had some 100-mile-an-hour gusts, and, there was some stuff got shook off the wall. So my wife tells me, I have to confess, I actually slept through the storm. My wife wasn't real happy with me, but we didn't lose so much as a shingle off of the roof. One little orange tree in the backyard fell down, and the wife's already tied it up with ropes and pulleys and all kinds of other stuff to see if it'll take hold again. So no real damage done. It was quite an experience. Much stronger than expected, but we weathered it. We were really not quite 2 days without power. A full day without power. It was about 18 to 20 hours, somewhere in there. So we came through the storm just fine. Lots of other folks in Florida, and don't forget out in Texas, did not do anywhere near as well, and the rebuilding effort is going to go on for a while. And it's going to, by the way, it's going to mess with the GDP figures, because in the short term, you're going to see some declines in consumer spending and that sort of thing. And then in the longer run, all this economic activity of rebuilding is going to temporarily make the economy look a little bit stronger than it really is, because the way we measure GDP, all that economic activity will show up, but there's no offset for all the wealth that was destroyed. So it's kind of the broken window fallacy in action. It's really going to distort the next several months' economic figures. So we're probably not going to be able to give as much weight to those as we might normally. So anyway, in the banking world, still some signs of M&A acceleration. I know that the bankers I'm talking to are telling me they're talking to more people, whether they're buyers or sellers. And we're seeing some of the tired banker syndrome start to play out again. This was really prevalent in 2012, 2013. That's where, you've been in the banking business all your life. It's been a great business. Really has, right up until 2007. All the civic clubs in town, playing golf with the business leaders on Saturday, and people came to you to borrow money to build their business, send their kids to college, buy their homes, buy their cars. And you were a great guy, and it was a great business, and it was really easy to earn 12 and even 15% returns on equity. You probably IPO'd your stock, did a little public offering. Everybody in town owned stock. They were happy with you. In 2007, that changed. And banking wasn't fun anymore. And your stock price was well below the initial offering price. You weren't making loans to help people. You were foreclosing loans on people you went to high school with and having to deny college loans. And it just wasn't fun anymore. And then to top it off, here come the regulators, and they're going to give you whole new stacks of rules and regulations. And you used to talk to your outside attorney maybe once a month, make sure everything was in good order. Now you're talking to him twice a day. It's not fun to be a banker. You're tired of it. If you can cash out, get a decent price for your bank, you're out of here. And that was a very prevalent attitude for several years. Now, with Donald Trump coming into office, without getting political about it in any way, shape, or form, there was some expectation that we would see meaningful tax reform, meaningful small bank regulatory reform, and none of that's really happened, and it keeps getting delayed, and there's not a lot of confidence anymore that this administration can pass the type of drastic measures that the bankers were hoping would come along. Stimulate the economy, raising the net interest margins that they were earning, and also provide a bottom line bump in the form of lower regulatory and tax costs. That's all delayed. A lot of bankers are just throwing the hat in. Let's sell this bank. Pricing is fantastic right now. We can probably get a pretty good price for our bank. That's over 1.5 times book so far this year has been the average deal price. If they can get that, they're willing to go home. Then you've still got all those willing buyers out there. larger publicly traded banks whose shares are institutionally held, where their investors are holding their feet to the fire for one thing and one thing only, and that's earnings growth. Well, guys, the economy really is only growing at about 2% a year, and that's in most of the growth coming in select industries and areas. So the loan demand and the product demand that could drive 10, 15, 20% earnings growth that's going to make your outside investors happy with you is not available through organic means in most of the country. It is available by acquisition, however. So a lot of these banks are sitting back, looking at the smaller banks, figuring out which ones fit into their business model, into their branch footprint. And I think we'll see a continued, we saw 3 deals just in our portfolio in August. So far none in September, but month's just about half over. We got a little ways to go here. And I think for the final 3 months of the year, we're going to see quite a bit of M&A activity that'll carry on into 2018. Now, if I'm wrong about that, that's going to be because the economy did pick up. We are seeing increased loan demand. We are seeing higher net interest margins. And regulatory and tax reform have made great progress and are working their way through the legislative bodies. Well, okay, so earnings are going to bump up 30 to 40% because of those measures in 2018. My stocks are going to go up anyway, so I'm not exactly going to be real sad about that. Biggest risk to the market, bankers aren't doing anything stupid. Wall Street's always doing something stupid, but they're not doing anything excessively stupid. So the biggest risks remain geopolitical. This past weekend, God bless the North Koreans, they fired another rocket over Japan. Now, the way this works now is North Korea can fire rockets and they can do nuclear tests, and nobody's getting too upset as long as they don't hit anything. 10 years ago, this type of activity would have led to a much more drastic sell-off. There's still a lot of cash looking for a home in a low interest rate world. So we're going to, hydrogen bomb tests, firing missiles over Japan. Market seems to be willing to just let that go for now. We are seeing a flurry of military drills from the U.S., South Koreans, the Japanese in the region, just to let the North Koreans know, hey, we have toys that blow things up too, and we're willing to use them, and we know how to use them, so you need to back off. It's not working. The president met with the Chinese premier over the past week, and they have had some talks about putting additional pressure on the North Koreans. The sanctions as they exist right now are quite strict. It's causing some deeper economic problems for the guy. But I think that the only thing that really brings him to the table with a reasonable attitude is to shut off the crude oil flow into North Korea. And so far, China has not been willing to do that. We'll see. It's the single biggest geopolitical risk on the planet right now, although there's plenty more to go around. We're still playing games with China over the islands in the South Chinese Sea. It's a discussion that needs to be had at some point in time, but I'm not sure running naval vessels up through the area when we kind of need their help with the North Korean thing is the right thing to do. But then again, I wasn't on the ballot last year and nobody really asked my opinion. But so that's an area of concern. Venezuela, Myanmar, Iran, anywhere in the Middle East, all potential sources of problems. And of course, we saw another terrorist attack in London just a few days ago. So geopolitics is the biggest risk in this environment. It's going to have to be a huge event because like I said, there's still money looking for a home. Stocks are the natural home. They're pushing it higher. Yes, valuations are very stretched, especially for the large cap stocks. But at this point in time, with interest rates where they are, and with nothing stupid going on in the financial system, there's no valid reason for them to go substantially lower at this point in time. We always talk about these things. We worry about these things. We have hedged against these things in the bank stock portfolio. But there's nothing to trigger a downside advance. So we're just going to sit still, stay the course, keep doing what we've been doing. The other potential risk, and this is the great unknown, and this is where you find out how smart somebody is, because if they give you any answer to the question of what's going to happen when the Fed unwinds its balance sheet, besides I don't know, they're either a scoundrel or they're just not very smart, because this has never happened before. This is a $4.5 trillion balance sheet that they're looking to reduce over the next several years by about 50%. Quantitative easing, buying all these bonds, was unprecedented. Unwinding quantitative easing is also unprecedented. Now, they're going to stop very shortly. Instead of rolling the maturing bonds over into new bonds, they're going to start just letting that money run off and keeping the cash at the Treasury level. They won't be buying new bonds. It takes a huge buyer out of the marketplace, okay? Probably the biggest buyer of bonds over the last several years. So what's going to happen? I don't know. I really don't know. When you take that large a buying presence out of the marketplace, I can't tell you how it's going to react. Could lead to a bump up in interest rates, but you're going to have an offset of a still weak economy. So weaker economic news may overcome that what's going to be a supply and demand problem for certain sectors of the bond market in the months going forward. I don't know. Will the market react badly? I don't know. I've talked to some people that said stocks will be fine. I've talked to others who are inclined to crawl under their desk with a bottle of cheap tequila and just kind of try to weather the storm. We'll see how it plays out. It's something to keep our eye on. As it stands right now, it's not a reason to panic or run and sell our stocks or do anything silly like that. So that's just kind of where we are. We've got our hedges on. We are practicing sit on our ass investing, basically. Most of the stocks that we bought over the past, that's 2.5 years or so. We haven't made a new buy in quite some time because we're not finding anything that's, remember, we pay unreasonable prices for banks. We've got a point where we want to buy our initial position, another point where we're willing to buy up to once we've established an initial position. We're very strict about the financial strength and the loan portfolio guidelines. Right now, there's nothing new coming in to our strike zone. Remember Joe DiMaggio and the way he hit? He broke the strike zone down into a bunch of different grids, and he figured out which grids he was able to hit the ball most of the time and which grids he couldn't hit. He only swung when a pitch was where he wanted it in the grid. We're doing the same thing. We're only swinging at the fat pitches. They're throwing us junk and off-speed stuff right now and stuff out of the strike zone. We're not swinging for the most part. If you're bringing new money to the table, stick with the buy list that went out last Friday, buy-rated bonus stocks. That's a chart of those that's up in the blog for subscribers to Banking on Profits. Not this past week, but the week before. We put that up there and they haven't changed very much. And of course, buy-rated focus picks. Now, the community bank stock investor, we're a couple days late. The storm did put us a couple days behind down here just with the craziness and running to the airport. We sent the 14-year-old up to her dad's up in Maryland, and of course we had to run back and forth to the airport. Then I had a trip out of town and one of those quick little overnighters that I really don't enjoy. But so we were a little backed up, got it into production a little bit late, but that should be in your email inbox tomorrow. We do have 2 new focus picks and a bonus pick from our old friend Phil Timian, a longtime banker, bank stock investor, and hedge fund manager. Great guy. We've stolen some pretty good ideas from him over the years. So we got a bonus pick from Phil in this month's issue. Anyway, baseball, barring a miracle, the Orioles have pitched themselves to death. If we win out and everybody else loses out, maybe we're in. There is a chance that if we sweep the Tampa Bay Rays in the 6 games we have against them coming up, that we won't finish 4th in the division. If we can sweep them, maybe we come in 3rd in the division, and that would be a nice surprise. I think the wild card is out of our reach. Now, if the season finishes the way it is right now, we will have picked all 6 division winners in our preseason forecast. I feel pretty good about that. I think the weak spot right now, the potential is the Chicago Cubs. They've got a 3-game series against the Milwaukee Brewers. It starts today. If they win that series, then I think they're just going to go ahead and walk into the playoffs. Most of the wild cards, they're all up in the air, so I'm not going to see how my wild card picks did against what the reality is. We'll talk about that when the season finally winds down. But this is going to be a fantastic 2 weeks of baseball. There are some wild card spots that are still very much in contention. The Cubs and Brewers, that's an interesting situation. Cleveland Indians, 24-1. They ripped off a 22-game win streak. That's a major league record. Now you can point to the one from 1916. Remember, they played 12, had a tie, and then won 14 more. So that's a 26-game unbeaten streak, not a 26-game win streak. So Cleveland, I think, has the win streak record, in my opinion. Put an asterisk in the book if you need to. They're red hot. The Twins are going to they can catch them. It's mathematically possible. But Cleveland's going to have to have a little bit of a losing streak, and the Twins are going to have to get real lucky. But anyway, some good baseball. Then the playoff baseball's coming up. I'm going to go ahead on the record and say loyalty to family above all. My wife's family, especially her nephew, are diehard Houston Astros fans. So from this point out, once the playoffs begin, it's go Astros around this house. So college football started. Notre Dame won, Florida won, Navy didn't play. There were some great games over the weekend. Our newly adopted team, the Buccaneers, did win. We didn't watch it. Just like I said, NFL just doesn't hold our interest that much anymore. And we had tickets to the King and I down at the Dr. Phillips Center here in Orlando. If you get a chance to see the touring production of the King and I, it is fantastic. Do yourself a favor and go see it. So now, recreational reading. The new Jesse Stone novels was out. Farrell Coleman has done a great job of continuing Robert Parker's series and his character, and this was no exception. It's a pretty solid read. And then we had The Girl Who Takes an Eye for an Eye, and of course that's a continuation of Stieg Larsson's The Girl with the Dragon Tattoo series. And here I have to say the author has done an absolutely fantastic job of continuing the series. Really seems to me to have captured the characters, and fantastic read. Highly recommend it if you're a fan of that original series. The Western Star, that's the new Longmire by Craig Johnson. Just book after book after book after book. Craig Johnson does a phenomenal job with this series. I've never watched the TV series. I need to fix that and do a little binge watching of that at some point in the future, because I hear that's also very good. But when you do this much reading, binge watching gets a little tricky. Anyway, that's where we are this week. Lots of baseball, college football. They tell me there's probably going to be some great programs coming up here pretty soon. We'll try to get back into it. Go Buccaneers. Who doesn't love a pirate? We'll see how that plays out. Baseball is going to be fun. There's some new books coming out, and the market should just continue to chug along. And I do expect to see some increased bank M&A over the next several months that should boost our portfolio returns even further. Anyway, that's about all I've got for you down here. It's about time for us to figure out what we're doing for dinner around Chez Melvin. So I will talk to you guys next week, and have a fantastic week.